Greetings traders and welcome to Exness Talks, your go-to source for the latest analysis and ideas from markets, plus tips for trading and more. Hello traders, greetings and welcome to another episode of Exness's analytical podcast from Exness Talks. And joining us today we have Stanislav Vernichov. Thank you very much, Stan, for joining us once again.
Thank you, Michael. Thank you for having me, and let's discuss markets.
Yes. So the key event that happened last week, or the key likelihood of future events anyway, is the reaction to the Federal Open Market Committee's meeting, and traders increasingly expecting that tightening is going to happen probably sooner and probably more strongly than previously had been expected. So let's discuss firstly what kind of effect has this had so far and what effect could it continue to have on commodity markets?
Yeah, we've seen this large sell-off on the commodity markets across the board. So oil, grains, other agriculturals, metals, including gold, everything plummeted just very aggressively. So because of the fact that Fed announced that it will fight the inflation, so that was the signal that Fed gave to the markets, to traders and investors. And investors actually got they received the ball and they say, okay, so inflation will be defeated possibly by Fed. So there is no way, or there is no sense to hold the stake for anti-inflation plays anymore. So at least this is the decreasing tension around the inflation. So all those anti-inflation stakes are kind of withdrawing from the market. So we've seen that very accurately on Thursday and Friday. Gold was going down, everything was going down. So American dollar was going up. And what is notable across the stock market, we've seen financial stocks and industrial stocks were going down. They were the main beneficiaries of the first and the second quarter in 2021. As you remember, inflation agenda was, I would say, very active, and financial stocks were boosted by that very massively. Goldman Sachs, JP Morgan, all those stocks were going up very aggressively. Now we've seen them correcting. And guess what gets back into play? Technological stocks. That's the most common pattern. When the inflation expectations are low or getting lower, technological stocks are getting more attractive. So that's what we see right now. Technological stocks like Microsoft, NVIDIA. NVIDIA was, by the way, one of the top gainers so far. But other stocks like Apple, like all those names, they get back into the focus of traders.
And if we look specifically at oil, relatively speaking, this wasn't one of the very big losers, US oil or Brent crude. Can you tell us a little bit more, Stan, about why you think, relatively this actually has been quite strong in the aftermath of the Fed last week?
Yeah, exactly. We've seen oil recovering today and on Friday. So actually now it gets back to the previous levels, the levels where it had been on Thursday. Well, oil, I would say, is one of the instruments which is not so sensitive to inflation, but it is sensitive to economic recovery. Mm-hmm. So we've seen those airplanes flying, and they require oil, and the demand for oil actually was low in the previous year, and now it gets back. So talking of the oil market specifically, we know that on the oil market there are commercial players, commercial traders that hold positions for the long term. This is the only market that doesn't have any net negative position among the big market participants. So in other words, if you take futures, oil futures are having positive open interest. At every moment in time. So, for example, currencies may have a negative net position. So somebody might bet against currencies or any type of commodity except oil. Oil is always in the positive territory. So in other words, there are people and companies that purchase oil for the long term, for the 1 year, 2 years, 3 years forward, and so on and so forth. That's why it is a very forward-looking instrument. So I think it discounts economic recovery, some quick economic recovery in prices, and this agenda beats the anti-inflation agenda. And specifically for this kind of market. Metals, on the other hand, are very sensitive to the inflation. So they were going up very sharply in the first and the second quarter. Now they're going back sharply too.
Hmm.
So they're very sensitive. So oil has the long term demand, which actually supports it from falling.
Hmm. Okay, clear. And finally, very briefly, Forex, specifically the dollar index, what do you think might be the outlook there based on the latest sentiment and generally moving away from the narrative of inflation?
Yeah, that's a surprise. In fact, the dollar index was growing substantially. So for the last week, possibly because of the very small interest rate hike, 0.05%, which was initiated by Fed. That was
Hmm.
I would say, the symbolic type of action that actually changed capital flows for a little bit. So, for example, American banks have deposited 756 billion, I think. This is the exact number of dollars on the balance of Fed. So 0.05%, the tiny number. But as some people joke in the internet, the 0.05 is the new zero 0.5. So
Hmm.
that's why this is the perception of the market. That's how markets perceive the current situation. That's why we've seen this rise of DXY, of the US dollar index.
Yeah, okay. Right, so thanks very much, Stan, for giving us your valuable insights once again.
Thank you, Michael. Everyone trade well and see you later.
And thanks, everybody, yes, for attending and hope to see you again soon.